scored. All right. Okay. So the first thing I do is I have these two levels on the fibs. Sometimes what I like to do is add the 38 and the 2236. And I'll show you why now. So normally what I do, I see a lot of people when they're drawing their fibs, they draw it like this, from high to low, like that. And then prices come in, a lot of people enter on a 61. Maybe they would have entered here, they would have entered here. Because a lot of people use the 786. So that probably would have tapped down here. And they could have got an entry. But what I do is I'm looking for short positions here. So what I'm going to do is draw it the opposite way, only including this candle. So a lot of people, they'd wait for price to come down all the way down here to draw the fib from the swing high to the swing low, wait for the pullback and then start selling. What we want to do is enter on the immediate pullback or the 50% pullback or the 70% pullback. I say a lot of the times when price fills the full imbalance, so say we mark this on here, if you actually press control, it locks on to the wicks or the bodies, so you can get like precise areas. And yeah, most of the time when it fills 100% and carries on upwards, then we could see price either come back, retest it, because a lot of the time order blocks are formed here, and then carry on to the upside. So that's why we don't usually look for an 100% fill. So if I actually draw the fib on here now, from the top to the bottom of the imbalance candle, this is on the 1 hour. I wouldn't look for them lower than the 1 hour personally, because I just don't think they're as reliable. It's like anything in trading. The higher the time frame, the more solid the analysis is going to be. It's same with maybe if you started with support and resistance trading when you first started. You're probably used to people saying the higher the time frame, the daily zones, the weekly zones, they're more respected. And that's the same with these imbalance areas. The higher the time frame, the more respected they are. So if we actually play price on, you can see we went down, we went up, and price came back and tapped the 23.6. So the main thing with these big imbalance candles is this area here, the 38 and the 23. Normally, say it was a small candle like this one here. This one isn't as big as this covered, 1, 2, 3, 4, 5, 6, 7 hours of this movement, or even backed down here, all destroyed by this one candle. When you have ones like this, where it's gone down, we've grabbed liquidity from this area here. I'll do another zoom on liquidity so you can get that properly. But we grabbed liquidity, so we swiped it, and we've come back up. So what we're going to draw now is the fib from this imbalance candle, like this. And as you see, happens again. A lot of the times, people will see the fib and then draw another fib if price comes down to the area again. But what I personally do is just use the same fib, because that area, this imbalance, hasn't even been filled 50%. Because if we put the 50% on there, it has actually just been filled 50%. But because the full imbalance still hasn't been filled, we can still look for buy positions off this area. And if we drag this along here, you can see you would have caught the buys here up into this area up here, and then you would have caught the buys here as well. Because if we go back to here, what you can do is go down to the 30-minute or the 15 and look for the free taps, which is what I personally use. So first entry I'd use on the fib is the 61. So when it initially taps into the 61, that's when I get the first entry. And the second entry would be on the 70. So that's if it obviously doesn't come down to the 23 or the 38. So if it comes down to them, starts rejecting them first, you can get your first entry. That's more like a scalp entry, a more riskier entry, because we haven't retraced to at least 50%. But when you see price like this, it comes down below 50%, tries to fill the full imbalance, but doesn't fill it fully. So we're still looking for buy positions. And that's where we are looking here, rejections in these areas. So if we actually play price on now to see what it did at this area on this fib we drew. So you see tapped in, reversed. And where was it targeting? Came back to this imbalance here. You could have had this as a final target. Let's see if that got filled. And there we go. You see pretty much to the pip, that imbalance got filled. So that's where I target as well. I use it for entries, using the fib and other confluences. Like here, we had the liquidity, had a grab of liquidity, and when price pulls up, it has to retest. A lot of the times, people will see price moving up. They'll FOMO in their entry. They'll see this big candle up here. They'll get in just because they don't want to miss the move. But price has always got to retrace. So there's no point entering just for the sake of entering when you can wait for the pullback and get the proper entry, the proper stop loss, and capitalize on the bigger move. So if we actually go on the higher time frame now, and you can see here, this candle lining up there. And where did we pretty much tap into? The 50%. And you could have even got a 38% here. Sell position wouldn't have hit your stop loss, and you would have been fine in profit. So, I wouldn't use these below the 1 hour personally. But say you're an intraday trader, a scalper, then obviously that's perfectly fine. But just know they can be disrespected a lot more than the 1 hour. That's what I've personally found. But if you go back and backtest this, then you will see for yourself and adapt it to your strategy, your personal strategy. If I just show you a few more examples of this, we have this area here. You see my first entry would have been if we had a rejection of the 61. We didn't have that, but we had 1, 2, 3 taps of the 70. A lot of people use 78.6, 76.8, 0.7. It doesn't really matter. It's all around that same sort of area. Same with, I know some people use the 62, doesn't matter as long as it's in that sort of golden zone. So this zone here, that's where we're looking for the rejections. And stop loss, where do you place the stop loss? A lot of people would just do it, as tight as they can. Say they're entering here, they'd have it just above this wick here to get a tight entry. With imbalances, as we know, they have to be filled. And once we've rejected off this fib, we put our stop loss. You could have had it literally just above the imbalance. It wouldn't have been hit. But it would have been hit with spreads, depending on your broker. So what we do is we put them a few pips above. I usually aim for most trades to have a 30 pip stop loss. I never usually go above that. Say I'm swinging a trade using the 4 hour, entering the 4 hour, maybe I will use a higher stop loss. But especially with gold, when you're wrong, you want to be out of the trade as quick as possible. And then maybe you could look for the opposite direction trade. So with the 30 pip stop loss, it's big enough for gold. You can use it on other pairs as well. You probably have a 15 pip on another pair because gold obviously has a bigger value. So here you would have entered on this imbalance. We had 1, 2, 3, the triple tap in here. And then we melted down. And where would you target? First target, you could have targeted there. Another imbalance candle, which has yet to be filled. And where did it come down to on that wick? Right to the pip of that imbalance candle. We also did have a bit of liquidity down here. As you see, a double bottom. So what's below a double bottom? We have a lot of orders because prices come down again. Buyers' stop losses are below this level. So what have we done? We've come up here. They're in profit. They're entering more positions. And what we're doing, we're selling into their stop losses. The next target could have targeted this imbalance here. As you see, yet to be filled fully. If we draw the fib, you can see that we did only come to the 70. Again, another perfect entry. And if we draw that across, because as I said, it doesn't have to be tested only once. We can test it again. And there we had another second entry. That would be the second target for this trade. And that was pretty much hit perfectly. And then we did reverse again. So you can see that these areas can act as reversal areas and are good to take profits at. Maybe it comes into this area, your take profit 2 is hit. You maybe take 25%, 50% of your trade off and just let the rest run. You could even make it risk-free. I don't personally make my trades risk-free. I just hold to the stop loss or the take profit because they're there for a reason. And on this trade, another target could have targeted this imbalance here. Could have targeted this imbalance here. All these imbalance areas which you can target, maybe take a bit of profit off each one and just let the rest ride. You could have an initial target and then start trading your stops. Then if it gets stopped out, you're still making a good few percent profit. So say you're in this trade, you took 50% of profit here, that's 4.5%. And then you trailed your stop. You would have been stopped out. Where would you have been stopped out? In 4.7% profit. So with these imbalances, I personally use them as targets and entries. A lot of people just think they're useless, but as you've just seen, when you're using the fib on the imbalance, not from the high to the low, because if you're doing it high to low, this area wouldn't have been hit using the fib. It would have been invalid. So if we actually draw that now, high to the low here with the wicks, which is what normal people do, high to the low of this candle, invalid. But what we do, body only, like that. Perfect to the pip rejections there, 3 rejections. We did grab liquidity to fill the imbalance here, and then we dropped. But a lot of people with the tight stop losses, they would have been stopped out. So if we actually look for another example of this, this is what happened this week with it as well. You see this big move up. We could have got an entry on this here. However, that was FOMC, but that first tap would have been perfectly on the 50% of this move up. Same thing here. What do we have? A lot of people, they'd be drawing it high to low like that. They would have been in this trade here. They would be in profit. They get stopped out. But where would we draw it from? We draw it from top of this candle here to the low of the candle there. Draw that across and look. 1, 2, 3. You could have got the entry and boom. Absolute perfect entries. And this one, you could have got a very tight stop loss. Because as you see, the imbalance had just missed the full fill. So what could we do? Got a stop loss just above there, just to be safe. You could have just had a 30 pip, just to be safe with it. But let's just say we put it above the imbalance, above that wick, around this liquidity. And then, price came down for a 1 to 6. A little tip when looking for these imbalanced targets, you see here, we have the double body up, double body down, double body up. But you see when you have these random wicks like this, you don't really get reversals. But when you have these 2 candles, one down, big one up, that's what you could say it's an engulfing, but sometimes it doesn't engulf. But these are called double flat bodies, and that's where price can reverse off. We had that again here. We had that again here. You could even say this one here came up, double flat body, reversed, and that was also in line with the fib. So, your confirmations for this, if say you like more than 2 confirmations, you had the imbalance being filled, the fib rejections with the triple tap. So the triple tap could have been 3. I would count it as 2 because that's technically a triple tap of the fib. And also we had double flat body. And then we did catch the move. Personally, I wouldn't have traded this buy up because we did have obviously the FOMC news. But if you actually look, we did have this move down, which set up the buys, which I'll go over later, maybe in the next one, the next Zoom, on why this move actually came down first before we went to the upside, because there is a reasoning behind that, why we have these moves up before the moves down. like what we had here. Why did it come up before it came down? So I'm going to go over that in the next one, but I just want to focus on imbalance areas. Does anyone have any pairs you want me to show an example on so you can see it for how you actually trade?
You want to do it on GA?
GA, yes. GBP. Oh God, what is this? All right, I'll just remove all the drawings. All right, so if we look on GA, find an imbalance area. You see, when it's trading like this, I wouldn't really be looking for many entries because you see there's not really many imbalance areas. And when there are imbalance areas, they're getting filled very, very quickly. But say you even drew one on this, you could have got 61, 70 entry. I saw a good example here as well. If we draw it on this candle only, you can see perfect. So we had these double tap here, another tap, could have caught these buys up on the short fill. So this is when price comes down quickly, big move up. And then we had it again here, 1, 2, 3, could have caught the buys. So say you caught the buys here on this third tap, you had your stop loss below there, or even below this level, depending on how you want to trade it. But let's just say you had it down there. Then targets, first target for GA, obviously you have these psychological numbers. If we just mark that on, coordinates, so 8.7, that would always be my first target with GA. The next psychological number, obviously we had 1.86 just there, but I don't usually like to target like 20 pips, 30 pips, because there's just no point, especially when you're using like a 30 pip stop. There's just no money in it. I'd rather focus on waiting for the move, but then catching a few hundred pips. Like as you see here, say you took some profit off at 1.87, you had 1.88, then you had 1.89. And if we actually go on a higher time frame, you can probably see what happens around these areas. So if I actually mark them on, so we have 1.86 as well. So yeah, like you can see here, comes into these areas, reverses, and then we have a lot of consolidation and wicks around these areas because the psychological levels, that's where the banks take their profits and close their positions, enter more positions. So there's a lot of liquidity around these areas. As you see, we had to test this area before we continue to the upside. 1.88, I think that might have been news based with inflation, but if we go back, we could probably see it again when price was at these levels. So yeah, when we break through, we always come back to test like this. We break through, came back to test 1.87, broke through 1.86, had to come back to test 1.86. And 4-hour fibs work exactly the same as 1 hour. I wouldn't really change them at all. But if you're doing it like this, you will have to have bigger stop losses. So as you see here, wicks, move up. And then if we extend that along, what do we have? Perfect tap of the 0.8, 0.7, my preferred entry. So this would have been my preferred entry. I do like to enter on these, but I'd rather wait for a 0.7, a 0.61 tap. With the free tap here, that's like a perfect entry. So we had the imbalance. We've come back to test it. We tested it once around 50%. Then we came back to test it again. And then we have a move up. To test, where do we come into? If you look, 1.84 exactly, and then reverse. So with this, what would your risk to reward be? So let's say you enter here, the third tap, stop loss below there, not the greatest risk to reward, but you probably would have gone down to the 1 hour to refine this entry, or even the 50-minute, 30-minute. I don't usually go below the 30-minute now. I used to go on a 50-minute for the entries, but I found a lot of the times my levels weren't holding. So that I used to draw the fibs on the 50-minute, they just weren't holding. So that's why I've moved up now. I take less trades, but the win rate is a lot higher. So say you're targeting here, you've almost got a 1 to 5 risk to reward trading on a 4 hour. Although these trades will take a lot longer with the higher time frames, that was over 4 days, but it's worth the wait. rather than trying to scalp 1% here, 1% here, 2% here, but then you to have a loss, a few losing trades in a row, and you pretty much should break even. But a trade like this, you wait for the perfect setup. You could have caught the buys here. You're in profit. And we look where it reversed. Double flat body, double flat body, double top here, double top. What's above here? Money, liquidity, all in this area, as you see here as well. And what happened here? It swiped the liquidity, came above the double top, swiped it, another double flat body, tweezed the top as well. A lot of you might be familiar with that one. And then we dropped down, touched the fib and up. So a lot of different ways, which I'm going to go over how you can actually enter on these trades. You could have even entered on this liquidity swipe here. That's what we're going to call it. And then we came down to test the fib. But with gold, I don't usually focus on the psychological levels as much as GA, because on GA you have the 1.84, 1.83, 1.82. But if we go back on gold, the main key levels are like 1900, 1925, 1950, those sort of levels. So as you see around this 1800 level, this whole level here, if we draw this out, a lot of liquidity generated. Even if we draw this back here, you can see so much liquidity generated in this area. So if we go back on the 1 hour, look here, another example of a liquidity swipe. So we had this build up of wicks. So wicks into the area. We're struggling to break above, but it's holding. So what's above here? Stop losses. Retail traders, they're trading this, if we look, as a support, turn resistance. They've got the break retest. They're entering sells. They enter a sell. Their stop loss is just above the level. What's this doing? They're in profit. Yeah. Came back up, took the stop losses, and then we make the move. So you don't want to be caught by the stop loss hunts. That's what people call them, but it's literally just grabbing liquidity. The big banks don't care about your stop loss when you have a $5,000 account, a $10,000 account, probably a $100,000 account. They don't care about your stop loss, but it's just the number of stop losses and the amount of money above this level, which means they have to grab it to actually have enough money to make them move to the downside. Because say, I have a customer on the big banks, I have a customer that wants to buy or short in this case, let's say Facebook shares. So they want to short it. You could have shorted here where all these orders are created, but you want to get them in at a better price. You want to make them more money so then they'll come back to you and use you again. So what do? You push price higher above other people's price. So you use your own money to push it higher. That's what the banks are doing, above collecting all the orders. And then you're getting them in at a higher price. So when you short it down, so when you're selling it, they make a lot more money. The same when you see the wick to the downside, they're making price cheaper for their client to get in by using their own money to move price down to then push it right back up. So their client makes more money by getting them in at a cheaper price. And why do the banks do this? They want to make more money for their clients because they'll come back to them, use them again to, make money with their company. You see it here again, liquidity here, boom. A lot of the time it has to be tested again. So as you see here, if we go down on the lower time frame, we had all this liquidity build up. We had a double flat body, and what happened? It broke it, came back. So even if you missed a breakout, this is, I wouldn't say it's a break and retest strategy because you're trading off liquidity zones. So it's not like a support and resistance basic buy when it breaks and retests the resistance, or sell when it breaks and retests the support, because we're trading liquidity. I think it's a lot different. That's why people get confused with so-called institutional trading, because they see it as like order blocks, trading with the banks. But it's not really like that. You're just trading the opposite way to the normal retail traders, not like opposite way to the 99% of traders, which are obviously failing. So the money is where their stop losses are at. So they might win a few trades, but the majority of the trades, because they're obviously 99% fail, the majority of their trades must lose. So why would you use a strategy that 99% of people use, like support and resistance, when the majority of traders lose? So when there's obvious setups, like support and resistance setups, that they're going to be liquidity grabs. And they just call this the banks manipulating price to stop them out. When they don't realize that they've got in too early, they should have waited for price to grab the orders before actually entering a trade. But no one is taught this properly, which is why most traders fail. But does anyone have any questions on the imbalance and drawing a fib from the imbalance? Okay.
If that goes through the 0.7, Will, does that do you stop not place the trade? Does that mean that's not going to be a profitable trade if it actually smashes through the 0.7 instead of just tapping it?
I'd say so. Say we drew the fib here. Obviously we've broken straight through. So on the 1 hour, this is where all the wicks were. But say you were looking on the 30-minute, we've had these taps here. If you're entering here, you've got your stop loss up here, so you should be safe. But say you miss the entry and the fib comes back down, people usually think, oh, it's invalid now, closed above the fib. But these fib levels are here for a reason. The imbalance hasn't yet, just been filled. So we've collected the orders from the upside in this liquidity area. So now we can look for a retest. And when price moves away from an area, you see, what does price do every time it goes in a direction? It comes back. It goes down, it comes back. So I'd say they're still valid. So you see price came up, closed above, came back down. Where did it test again? The 61 and closed both candles below the 50%. You probably could have even drawn another fib, maybe on this candle here or these two candles here. And if we remove the first fib, say you missed the first one, drawn it on these two imbalances, which on the hour would have been one imbalance candle. Price came down, came back up, tested the imbalance, didn't fill it all the way. Then you had a 70 and a 61. So I'd say it's not invalid unless obviously price closes above the imbalance. And then most of the time when it closes above, it fills all the imbalances and just keeps going, then the sales are invalid in this obviously example. So say price came up above here, started consolidating, collecting orders. Maybe it could have grabbed liquidity again below and then started moving up. But say we just have like here, the fib level was there. We have a little push above, back down, test the 61 and a 7, boom, back down. But this is obviously different in each example. But I'd say if price comes down and tests it again, then I'd take the trade. I'd personally say it's still valid, that you can get the entry on it. Obviously, if it still gives you a good stop loss and we haven't closed way above the imbalance or the liquidity area. So yeah, I'd say they can still be valid if we don't close way above. I'll find an example where it's invalid. So we could try this one here. So you see this here, we had obviously 1, 2, 3 rejections of the 61, but then we've blown straight through. And even if price came back down here, I'd say it was invalid because you see this imbalance here. We've gone below, we've closed very bearish below this level. So I wouldn't be looking for price to come up, test it again and then buy. But in the other example, we held that imbalance area, we held that liquidity. So I knew that we could still look for sales. But in this example, as you can see, big bearish momentum to the downside. We had this imbalance candle created, filled it immediately, tanked to grab liquidity at this area below this imbalance candle. If we look across here, where was it? I had a good example of where you could get 2 entries on it as well. I think it was this one here, might have been. If we just zoom out on this. So yeah, this one here that I drew earlier, if you draw this across all the way, you see you have the entry here, you have the entry here, have the entry here, have the entries here. And you know, price did come down just before the imbalance, came back up, tested the 61, and then we go up again. And you know, this fib, if you got any of these entries and your stop loss was, you know, just below the imbalance, then you probably would have caught, you know, this big move up here, this big move up here, could have caught these moves here, these moves here. And if you got the right targets, then you'll be making money from all these moves. So you got in here, you're targeting the imbalance fill here and the double flat body. You would have been tapped in, boom, reversed. And maybe you could have got, you know, another entry. Obviously, depending on your stop loss, you would have had, even if it's right down there, 61 pips, you got a 1 to 2. But like I said, I use a 30. So if you got back on this second tap, you would have got, you know, a 1 to 4.3, which, say you're doing funding talent or FTMO. On funding talent, you only need 2 trades like that to pass your challenge. And you could, you know, got that easily. One tap here, you've entered. Another tap here, you know, you might have been stopped out maybe on this one, but then you've got another one here. So 1 win makes up, you know, 4 or 5 losses. 1 or 2 trades, you know, you've passed the funding talent. I've actually used this strategy this last week on the funding talent. 3 trades, 3 wins. So, you know, a lot of these traders, they just tell you all these strategies and stuff. They don't have the results to back it up. So that's why I post all the charts in the chat that I enter. So if I post a chart in there that has an arrow going down somewhere, I've probably entered the trade. I'm looking for price to go down to that area for my target. The reason I don't post stop losses is because, especially with gold, it does get manipulated a lot, especially in these high liquidity areas. As you can see down here, we did have a lot of manipulation, liquidity wicks, test wicks. So sometimes I don't actually place a stop loss, but I have a mental one. So that's why I would show my stop losses, my take profits. But from what I've taught, what I will be teaching you, I don't think you'd need it. You should be able to do it all yourself, and be self-sufficient in the trading. Like with these imbalances, when I said they can't get filled fully and carry on above, and the sales won't be valid. If you have a situation like this, so you have an order block here. So you have the order block, which is usually created before an imbalance candle, which happens majority of the time. So you see, we kind of had order block here, drop down. Where did price come back to test on this one? The order block here. And where did it also test and close below? It wicked into the order block, closed below the 70%. So, you know, here you've got the order block, the imbalance filled to the pip. We've got rejections, 1, 2, 3, free tap, and boom. I wouldn't enter solely off this, but it's a good thing to look out for. You know, if you have a few other confluences, which will be shown later in the zooms that are coming up, then you can get entries off of these order blocks fairly easily. Obviously, depending on the confluences that you have in each situation is obviously different. But these order blocks do happen a lot before an imbalance. So as you see here, we had the same sort of thing going on. So we had the order block before the imbalance came back, tested, liquidity created. And this was also the liquidity grab, created the imbalance and the order block. And what does price always have to do? Comes back to test this area. So don't worry if you miss a trade. You know, there's always going to be a retest. There's always going to be price come down, at least as I've shown 38.23. You get these like immediate pullbacks on these sort of levels. So you see even here, this candle, if we draw the fib, you would have got to the pip of 38 and you could have got an entry. So it doesn't really look like a pullback. That's why I'm saying immediate pullback. So on the next candle with the 38 and the 23, I wouldn't look for these 61 and 70 on the immediate pullback, but that's why I have the 38 and the 23. They're like the next candle, price comes down, you miss the original move and you just want to get in, or maybe want to scale in on a winning position. That's when I'd maybe enter another position, maybe a smaller lot size, just to scale in, try and maximize your profits. Because say your first position is at break even, maybe you secured some profits. Say you've secured, let's say 2% of profits. If you enter another position, you're risking 1%. If that trade hits stop loss and your other stop loss on your first trade is at break even or trailed, you're going to end up in profit anyway. So there's no harm just re-entering if you have valid confirmations for another entry, even though you're still in the trade from, let's say, earlier on. Say you're in from here, price comes up, you see an immediate pullback and you still have valid analysis to say price is going to go to the upside, then that's where I'd look for another entry. An example like that. And, it happened to the pip in this area. Is anyone confused on any of this that they want me to cover?
No, it's all good for me.
Perfect. Has anyone used imbalances before this? Because I know I showed it on
What time
YouTube.
frame is best to use to find an imbalance?
I say 1 hour and 4 hour. You can look on the daily, but these levels aren't, it can, especially on gold, it can take a while to fill these imbalance areas. But if we even look here, what do we have? This imbalance candle came back up 1, 2, 3 taps, 38 reversal. That's a good amount of pips, 360 pips. But I personally, I think most of you are day traders, so 4 hour and 1 hour mainly. You can go down to 30-minute for obviously entry confirmations. So say you have a tap into the fib that you've drawn on the imbalance on the 1 hour, go down to the 30-minute maybe, wait for those 3 taps, get your entry. You might even be able to get a tighter stop loss by using the lower time frames, dependent on how big the imbalance candle is. Because obviously the bigger the candle, the bigger the stop loss will be. That's why I don't usually look on the daily, because say you're entering sell positions based off of these 3 wicks here, you've got to be careful the price doesn't come up to fill the full imbalance. And you don't want a 300 pip stop loss. That's why I'd usually, there's probably more imbalances here that you could have looked to enter off on the lower time frames and maybe have got a tighter stop loss. So that's why I don't usually go below the 1 hour or above the 4 hour. 8 hour, that's, it's all right, because say we're on the 15, this is a good way to put it. So you have all this indecision, all these areas. You have random wicks. Let's go back to another area where we had imbalance. So yeah, like here, if we go back, so we have clear imbalance candles, but say we went up from the 15-minute, we can have a proper understanding. As you see, we have it in 2 candles. Instead of being like, oh, where do I draw the fib from? Do I draw it from to this one, to this one, to this one? Do I draw it to the top? Rather than getting confused on stuff like that, just go up to the 1 hour. See, it's so much clearer. You could draw it from the body to the body of this one. And if we play price on, as you see, 61, boom. And, we had the reversal. Tapped in order block, tapped again, 1, 2, 3, and you could have got another entry maybe. You would have been stopped out on that one. But because of your risk to reward on this one, say you got another entry, you got stopped out, it doesn't matter. Losses literally don't matter as long as you're catching high risk to reward trades and you're not entering trades, 2 to 3 per day. I only enter like 1 or 2 per week. This week, I entered 2 trades on gold. I can go over them as well. Let me just see, where did I enter? All right, so I'm pretty sure a lot of people in the group actually enter this as well. I think it was sales from here, because we did have, if I just change this to just, there we go. So this was a perfect example of the fib that, I actually entered on. So I entered like there, I'm pretty sure. So we had 1, 2 on that third tap. What do we have? On the fib imbalance, not fully filled, but we've 1, 2, 3 taps. That's good enough for our entry. Usually you can use session volume indicator, which I'll talk about later. You can use session highs, session lows to target, to enter, to be careful of as well, because they can be taken out before you make the move. Stop loss, 18 pips. 18 pips on gold, crazy stop loss. And where were we targeting? I think I posted that my target was 1790. And the reason for this was this here. So this was the London low from the 23rd. If we look at the date, when was that? Yeah, so last week's London low. So these wicks have to be filled. It didn't get filled this time because obviously we had the dollar weakness from the FOMC press conference. But we did obviously take our profits down here when we had all this liquidity. We had all these double flat bottoms. And before FOMC, I just closed out my position in profit. You could have just made it risk-free, trade through the news, but it's better to just secure your profit rather than take the risk of losing it all on a news event, which can, lose your profit, hit your stop loss in a matter of seconds, especially with all this volatility here as well. So that's how I use imbalances and the fibs. I will go into more detail on other confirmations because although it does look pretty simple just using these, I wouldn't enter. So say there's just an imbalance candle, I wouldn't just enter if it came back to test the fib and then just buy. I have other confirmations, which I'll go over in the next scene, which will probably be next week at the same time. And this one will be recorded and uploading. But yeah, I hope that did help. And I'll see you in the next Zoom.